Hi everyone, and welcome to our webinar on Latin America, in which Ricardo Aceves, Senior Economist for Latin America and Commodities, will answer the question of whether this year will be a turning point for the region. My name is Miriam Dowd. I'm the Marketing Manager at FocusEconomics. To tell you a little about us, we are a macroeconomic research firm providing consensus forecast and analysis for the economies of 127 countries and prices for 33 commodities. We have been providing economic intelligence reports to hundreds of clients around the world for nearly 20 years. In this presentation, Ricardo will cover the economy of Latin America, which is facing an interesting year to say the least. He will examine the current state of the economy and explain how it ended up in recession in 2016. He will then discuss the main drivers and risks to the outlook for this year, taking a closer look at the domestic and international factors impacting the economies of Argentina, Brazil, Chile, Colombia, and Peru. We have given special focus to Mexico and the likely impact of the Trump administration's policies, as this topic is of great importance for anyone doing business in the region this year and beyond. Without further delay, I will turn the presentation over to Ricardo.
Thanks for the introduction, and thank you everyone for joining us for our first webinar of 2017. Let's start with a brief overview of Latin America's economy. Latin America likely contracted 0.7% last year. The recession was caused by a combination of the pronounced economic deterioration in Argentina, Brazil, and Venezuela, lower commodity prices, and heightened volatility in financial markets. Latin America is heavily reliant on commodities. It produces around 50% of the world's soybeans, 40% of copper, and 50% of iron ore. Not surprisingly, growth was fast during the commodity supercycle between 2002 and 2008. A normalization of commodity prices following the global financial crisis translated into significantly lower growth rates between 2010 and 2016. The sharp drop in commodities prices prompted a deterioration in the terms of trade, a substantial fall in fiscal revenues, and a massive outflow of capital. As a result, exchange rates acted as a first line of defense, depreciating substantially against the US dollar. In an environment of high currency fluctuations, many countries embarked on a drastic policy adjustment, with governments restricting public spending and central banks tightening monetary policy. This caused growth to weaken even further, and business and consumer confidence fell. In this graph, we see clearly that although most countries saw steady but uninspiring economic performance last year, Argentina and Brazil were the main drags on the region's growth. Argentina embarked on a series of structural reforms, causing the economy to contract, while Brazil remained in its deepest recession it has experienced in many decades. 2017 should be a better year for Latin America, despite important risks, which I will highlight in this webinar. Our consensus forecast shows that the region will grow 1.6% this year, following last year's contraction. Relative to other emerging markets, this represents a large turnaround for growth. However, it is still well below the potential of 2.5% growth, and this suggests that the economy is vulnerable to the increasing risks it faces. Latin America's upturn this year will be supported by a gradual recovery in commodities prices and an improvement in the global economy. In terms of individual countries, the recovery will be led by Argentina and Brazil, which according to our consensus will return to growth in 2017. Chile, Colombia, and Peru are projected to accelerate this year, while Mexico will slow. That said, important external risks are materializing. These include tough Brexit negotiations, faster monetary policy tightening in the US, and the impact of the Trump administration's actions and policies on the Americas. Mexico will suffer the most given its deeply integrated trade and business cycle links with the United States, and I will go into this in more detail later on. The rest of Latin America doesn't appear to be on Trump's radar for now, but there are risks that protectionist policies could damage the region's agricultural exports to the United States. On the political front, several countries in Latam will hold key elections, including Argentina, Ecuador, and Chile, And this year will also set the stage for presidential elections in Colombia, Mexico, and Brazil in 2018. Now let's take a closer look at Argentina, which experienced a year of transition and recession in 2016. Since assuming office, President Mauricio Macri had overseen a host of economic reforms aimed at addressing the destabilizing macro and micro imbalances and setting the economy on a more sustainable long-term path. Those reforms caused a deep recession. Tighter macroeconomic policy, devaluation of the peso, and an increase in energy tariffs had an impact on purchasing power and domestic demand. The economy is expected to have a meaningful recovery this year. Our consensus shows that GDP will expand 3%, helped by a solid growth in infrastructure and agriculture, and supported by an increase in consumer and investor confidence. That said, Argentina still faces strong headwinds from the troubled Brazilian economy and still low commodity prices. Argentina will hold midterm elections in the fall, and the government will feel pressured to make good on its promise to return to growth. Inflation is the main complicating factor for Argentina's recovery. As shown in the graph, inflation reached a 15-year high of 41% last year. This predominantly reflects the devaluation of the peso in early 2016 and an adjustment to energy tariffs. Inflation should moderate this year on the back of tighter monetary policy, a stabilization of the peso, and better accountability on the part of the central bank. A moderation in inflation should support private consumption as households' purchasing power improves. Now looking at Argentina's neighbor, Brazil's economy started the year on a shaky ground. It continues to struggle to crawl out from a deep recession. On top of that, political instability related to the Lava Jato corruption investigation is still harming economic activity, and there's no end in sight. Nevertheless, President Temer will continue with his reform agenda in a bid to bring about a long-standing economic recovery. Our poll of 38 experts see the economy rebounding to an expansion of 0.6% this year, thanks to a more market-friendly policy-making expected in the second half of this year. Social security and labor reforms are taking center stage in Congress. These reforms will be sufficient to help stop the massive increase in public debt to GDP ratio in the long term, which is currently over 70% of GDP and rising. Turning to Chile, the important event in 2017 will be the general elections, scheduled for late November. The consensus shows that the economy will accelerate mildly to 2.1% this year, but the sluggish upturn will probably mean defeat for Michelle Bachelet and her Nueva Mayoría coalition. Chile's uninspiring economic growth in 2016 reflects a sustained period of weak Chinese demand for Chilean copper. The slower economic growth also contributed to an increase in unemployment. Bachelet took office in mid-2014 on a platform of wide-ranging social reforms. Unfortunately, the second term coincided with a plunge in copper prices and weak fiscal revenue. It is important to know that key parts of her program have been delivered. Many university students benefited from free tuition, reforms of corporate tax have helped to increase social spending, and the labor reform will strengthen the power of the unions this year. Further economic reforms are unlikely to materialize given the political timing. Bachelet is likely to be a lame duck president and will not be able to push through substantial policy initiatives. Disappointing economic growth this year will likely fuel prospects of center-right coalition Chile Vamos, returning to power on the promise of pro-growth reforms and a harder line on immigration and crime. Recent polls suggest that former President Sebastián Piñera will take the helm of Chile Vamos and possibly the presidency. Piñera presided over a period of high growth in the wake of the 2009 financial crisis. Moving on to Colombia. This year's challenge will be implementing the peace accords within the context of political polarization and preparations for the general elections next year. Along with the peace accord, Congress passed the long-awaited tax reform championed by President Santos, And this reform aims to bolster tax revenues and allow the country to retain its credit rating amid a slump in oil earnings. Our consensus shows that the economy will start recovering from last year's massive drop in growth as crude oil prices increase. That said, fiscal constraints will dampen overall economic dynamics. The government faces many challenges related to the peace accord, including finding funds to cover the cost of demobilizing the FARC and reintegrating its members into society. The government will also have to finance reforms such as land restitution, invest in rural areas, while also financing military presence in areas the FARC had occupied. Government revenue will remain subdued in large part because crude oil prices will remain below the historical highs of the commodity supercycle. However, the fiscal deficit should narrow slightly this year, thanks in large part to the fiscal reform, which will tax dividends, increase the VAT, and taxes on businesses. Moving south, economic growth is resilient in Peru. The economy will grow 4.2% this year due to many factors including increasing copper production, higher copper prices, and President Kuczynski's plan to ramp up spending on public infrastructure projects. Investment will see a turnaround following 3 years of decline, and this will come mainly on the back of the opening of new copper mines and increased business confidence. As we can see in the graph, Peru's trade deficit shrank last year and will shift to a surplus this year. The improvement reflects that exports will surge thanks to higher copper exports. As new mines come on stream this year, copper output will continue to grow, and these, along with an increase in copper prices, will support export revenue, although rising oil prices will likely offset the gains and increase the import bill. Latin America's second largest economy deserves a closer look in light of recent events. Mexico, without a doubt, faces the greatest risk in the region from the anti-trade, anti-immigration policies championed by Donald Trump. Investors are nervous about the impact that Trump's policies can have on Mexico. This is evident in the extreme fluctuations that the Mexican peso is experiencing. The peso is an interesting barometer to measure the impact of Trump's actions and even his tweets. The currency took the largest plunge on record in mid-January as it became clear that Trump plans to make good on his promise to renegotiate NAFTA and build a shameful wall. So, what's at stake for Mexico? 12 million Mexican citizens residing in the US could be affected by a hardened immigration stance, and we could see the end of NAFTA as we now know it. Last year alone, Mexican workers abroad sent home nearly $27 billion in remittances, most of which came from the US. Remittances are an important source of income for Mexican families, and any impact on the inflow of transactions from the US could be harmful for private consumption, which is Mexico's key engine of growth. Trump said during his campaign that he could impose measures such as remittance seizure, tariffs, and an increase in fees for temporary visas. The risk here is that any shock to consumption could hamper growth. Regarding the renegotiation of NAFTA, at stake is $1 trillion in annual trade among Mexico, Canada, and the United States. Trump has threatened to levy a hefty border tax of 35% on Mexican imports. While he has the power to impose tariffs or quotas, such an action would undoubtedly lead to legal procedures against the US through the WTO or the US courts. Therefore, it seems that negotiation is a more appealing option. Since coming into effect in 1994, few meaningful changes have been made to NAFTA. Revising it could actually have benefits for both the US and Mexico. For instance, the US would likely focus on tax deductibility and improvement in dispute settlement systems and what are called the rules of origin, which determine how much of a product must be made within NAFTA's borders to to qualify for its benefits. Mexico could demand greater protection for agricultural producers and some forms of protection for nascent industries. Mexico could also push for improvements on migrants' rights. The goals the US may have for renegotiating NAFTA are still unclear. Mexico holds the weakest hand at the negotiation table. The country would welcome win-win proposals to improve NAFTA, and there is room to improve trade relations with the US in ways that are advantageous for both countries. One potential option Mexico can offer the US is to sign a parallel agreement on energy. Mexico recently liberalized its energy sector, and this means that there is now the opportunity to invest and exploit the sector, and the US businesses could receive preferential treatment. In turn, Mexico would gain guaranteed access to gasoline and natural gas coming from the United States. This would also be positive for the US because Mexico has been a net importer of oil derivatives since 2015, and its energy imports from the US could increase substantially, leading to a decrease in the trade deficit that Trump is so fixated on. Within the US political landscape, oil-producing states such as Texas, where the Republican Party has a strong preference, stand to benefit. In Mexico, the government had promised that energy prices would decline following the energy reform, but in reality the opposite occurred. A parallel agreement on energy would ensure a steady and adequate supply of fuel and gas, causing prices to fall, and the government could then show that it has made good on its promise to reduce energy prices. It is worth noting that NAFTA stipulates that any sector that was liberalized when the treaty was signed must remain protected. Mexico's energy sector was liberalized long after NAFTA was signed, and Mexico could attempt to include the sector in a parallel agreement. This would protect US investments and companies working in the Mexican energy sector, whereas other countries would not receive this same treatment. Such an agreement could form the basis of a full-fledged North American energy agreement. Looking forward, 2017 will be a difficult year for Mexico, and the government did not have any contingency plan for what could transpire following the victory of Trump. Trump's administration is still in its early days, and there is substantial uncertainty regarding the future of policy between the two countries. The Trump shock on the real economy has not been felt yet, but survey-based data related to business and consumer confidence and the PMIs are throwing up the first red flags. I see three possible scenarios for the Mexican economy in the coming year and beyond, which are corroborated by our poll of 36 analysts. Under the most benign scenario, Trump could decide to stop antagonizing Mexico and take a more pragmatic approach, in which he realizes that US businesses also stand to lose significantly from a trade war. Mexico's economic performance in 2017 and 2018 would not vary significantly from the weak but steady growth recorded last year. A scenario with substantial impact is one in which Trump continues pursuing his most radical agenda towards Mexico. And this is similar to what we have seen play out in recent weeks. Trump could in fact implement his full agenda with support of the Congress, at least during the first 2 years of his term. Under this scenario, the worst impact on Mexico would be a harsh renegotiation of NAFTA or the implementation of protectionist trade measures, which would severely affect Mexico's external sector. Other damaging measures could include the implementation of capital controls on remittances and mass deportations of illegal Mexican immigrants. This would put the Mexican labor market under pressure. At present, most analysts consider this to be the most likely scenario, with economic growth falling below 2%. The worst-case scenario that a few analysts consider plausible is Trump proceeding with a severe protectionist agenda, including the end of NAFTA. This would likely have a severe impact on Mexico's economic growth, and we would likely see the a recession in the coming 2 years. The analysts who picture this scenario have started to appear at the bottom end of the growth forecast chart. In this scenario, Trump would likely attempt to boost his popularity with a coercive attitude toward the Mexican government, which has few tools to counter such a situation. This means that there is significant risk of prompting political instability in Mexico, especially in light of the government's poor accountability and the 2018 presidential elections. Returning to our initial question, will 2017 be a turning point for Latin America? The consensus forecast of analysts shows that Latin America will rebound this year. Countries in the south are expected to see better economic performance, specifically in Argentina and Brazil, which will exit recession. The region's upturn will also be supported by a gradual increase in commodities prices and improved global economic activity. That said, the recovery will be underwhelming and it could be derailed by the multiple important risks that we have discussed in this webinar. In the north, the region's second largest economy is facing a very uncertain future. Mexico will have to find a way to weather the storm moving in from the United States. We can then conclude that 2017 will not be a turning point for Latin America given the multiple risks weighing on the outlook and, importantly, the future Mexico is facing. The analysts we collaborate with are certainly taking these developments into account, which could prompt additional cuts to the consensus forecast for individual countries and the region over the coming months. This brings us to the end of the webinar. I hope you found this information interesting. If you'd like to know more, please visit our website and LinkedIn profile or contact us at the email listed on this slide. Thank you very much for joining us today.